Welcome back, everybody, to another episode of Multifamily Report. I'm your host, Travis Watts. In today's episode, what we're talking about is actually the stock market. And though this is not a stock market channel, this is a real estate news update. We're all kind of correlated and in the same boat. When we talk about inflation, interest rates, the general economy, we're all being affected. So I want to tune into specifically what's happening in the stock market and how that's impacting multifamily real estate, and most importantly, what you can do about it moving forward. So without a doubt, the stock market's been on an absolute roller coaster ride. And in fact, one thing I think is pretty interesting is that the Fed funds rate about a year ago, this was November of 2021, was sitting at 0.25%. And as we sit here today, it is now hovering around 3.25%. And if you're not familiar, the Fed funds rate is simply the rate that banks and lenders have to pay to borrow money to be able to lend out. And so obviously, when they make a loan to you, I, or somebody else, they have to tag on extra interest on top of that. So that means if the Fed funds rate's 3.25%, you might be obtaining a loan for 5 or 6%. And I want to begin by letting you know that many economists are in agreement that when the Fed funds rate goes up after a Fed meeting, it generally can take 12 to 18 months for the general economy to feel the full effect. And to put this in perspective, at the Jackson Hole meeting just a little bit over a year ago at this point, Jay Powell, the chair of the Federal Reserve, had a speech that was very disinflationary in theme. At that point in time, the target federal funds rate was between 0 and 0.25%. What you see here on the screen is essentially the Fed funds rate probabilities. This is courtesy of CME Group, and this was published 10/16 of 2022. The takeaway here is that the assumption is that interest rates are going to continue rising for the foreseeable future. So let's discuss what's unique about today's market environment. And the first thing is, never in history, and I mean never in history, has the Fed raised the Fed funds rate in the face of an S&P 500 bear market, which is defined as more than a 20% drop from the recent highs of the index. And folks, this is what's happening today currently. Paul Volcker, which was the Fed chairman in the 1980s, raised interest rates in a very similar way. These increases caused back-to-back recessions in 1980 and then 1981 and 1982. And a 3-year bear market in stocks caused a brutal sideways move in the equity markets. On October 13th this year in 2022, the stock market had a wild day in the S&P, swinging from an intraday low of 34.99 to an intraday high of 37.11. So from trough to peak, this is a 6% move. This was ultimately due to the recognition that recession risks are rising. And that's crazy. That means essentially the news is so bad that it's actually good news for stocks. Now, if you think back about a year ago, I'm sure you remember some of the major headlines that were about inflation being caused by supply chain issues. China's ports were locked up because of their zero COVID policy. Or how about the Evergreen tanker that was stuck sideways blocking a major import-export canal? So today in Q4 of 2022, we're hearing a lot less about this type of inflation. In fact, commodity prices by some analysts are actually in a bear market, and freight rates have dropped substantially. But back to the question, what's unique about today's economic environment, and what should you look for as we move forward? So as I mentioned, the Fed has never in history tightened monetary policy facing a bear market in the S&P 500. And keep in mind that the stock market is a leading indicator for the economy. Number two, inflationary pressures are beginning to ease if you base that on the CPI readings, which is the Consumer Price Index released monthly. And you can learn more about that on BLS.gov. These are the government inflationary statistics. And if we do end up falling into a nasty recession, do keep in mind that cash flow assets tend to perform well in recessionary times. That's historically speaking, that's statistically speaking, and that's also what we've seen this year so far in 2022. So please make sure you have proper allocation among your investment portfolio. Again, this is never financial advice. I'm not telling you or anyone what to do. Please do your own due diligence and seek licensed advice. As we continue taking on all of the headlines and current news and events, the volatility, the asset allocation, and considering things like cash flow, please keep perspective in mind. Keep in mind, first and foremost, that negativity sells. So the talking heads and the gurus and the headlines really tend to focus on fear and the blood in the streets. The perspective that I want to leave you with is Warren Buffett's 4 steps to investing, keeping in mind that Warren Buffett has been claimed as one of the smartest and most successful investors of our time. And here are Buffett's 4 steps to investing. Number 1, turn off the stock market. Number 2, don't worry about the economy. Number 3, buy a business, not a stock. And number 4, manage a portfolio of businesses. So this advice may be more fitting than ever in times like these. Keeping in mind that a real estate private placement is a lot like a private business. It's not a publicly traded REIT. It's not a publicly traded company. It's not a stock. You are owning private real estate. And so if you want to learn more about that, you can reach me at travis@ashcroftcapital.com. I want to thank you for tuning in to another episode of Multifamily Report, news, industry updates, industry insights for you, the multifamily investor. Have a great week, everyone, and we'll see you in the next episode.